You to just drop. We would love to invite you to just drop into the chat your name, where you're joining from, and if you are in school, what school you're in.
Ah, scusa Angela.
Wonderful. Great. Well, hi, everybody. Thank you so much for joining us today. We are the Bread and Butter Ventures team, and we're super excited to spend the next hour with you. Want to make the most of this time and appreciate you tuning in for Venture Capital 101. We're going to kind of walk through a bunch of basics, mechanics, and overview of our work. And then we want to make sure we have a lot of time for Q&A from all of you as well. So please do jump in to the chat and introduce yourselves. And we're really glad that you're here. Okay, so just a quick overview of today's agenda and why we're doing this. So, Bread and Butter Ventures, we're a seed stage venture capital firm based in Minneapolis, Minnesota, investing across the US. And the mission of this session today is really just to open our doors and try to be a resource to any of all of you who are interested in learning more about venture or maybe are already in venture today and have a super transparent, ask me anything conversation. So, I just want to start by sharing briefly who's in the room, so who's in the Zoom. Everybody's about to tune in, but from an RSVP's perspective, we had RSVPs from people in 25 different states and 8 countries. So super excited for the mix that we have today. Just to introduce our team up front. So I'm Mary Grove, one of our general partners here at Bread and Butter. And the perspective that I bring is as a tech
Sites.
operator and really have a background in tech. So I spent the first 14 years of my career at Google, where I worked on the IPO team when we went public in 2004. Then I did a variety of emerging market expansion, business development work, and then ultimately started the organization that's today called Google for Startups. So really excited about just this opportunity to
Excuse me.
democratize access to capital and tech in more places. So
That'll
that was
work.
chapter one.
Um,
Chapter two has been all about venture capital. So I've been an early
um,
stage. Sorry, I'm just going to mute here real quick. Has been on the venture side. So I was an investment partner at a firm called Revolution on the Rise of the Rest Fund, and then now have been helping build Bread and Butter with the team here for the last 6.5 years. So it's awesome to be with you today.
And I'm Brett. I'm one of the other general partners investing here at Bread and Butter Ventures. My background into venture capital is through entrepreneurship. So I built several companies, both venture-backed, bootstrapped, kind of took it both ways. And about a decade ago, moved to the investing side of the world, first as an angel investor, and then as Bread and Butter Ventures. And I also had the opportunity to build the food tech and sports tech programs for Techstars that are based here in Minnesota. One was with the Minnesota Twins, the other was with Cargill, Ecolab, Land O'Lakes, are a couple of the partners that we worked with building out those programs. And so I've worked on the accelerator side, obviously the venture capital side, but was a CEO of many startups and always thought that that's what I would be doing was CEO in startups. One other quick note as we go through this today, if anybody has any questions that are relevant to the things that we're talking about, feel free to put them in the chat and we'll try and moderate as we go. And so we don't have to wait till the very end either for the Q&A.
Hi, everybody. I'm Steph Rich. I'm a partner on the platform side, which I can share a little bit more about later in this. I was a operator on the startup side, so an employee number one at a pretty high growing venture-backed company. And yeah, I'm a former journalism student.
Hi, I'm Anna. I'm our operations manager, so I run all things internal operations. I do a lot of portfolio tracking and data analytics and then running our fundraising process. So my background, this is my second job out of school. I started with Bread and Butter 2 years ago as an executive assistant, and then I've been our operations manager for the last year.
Just a quick overview of where we came from and where we are today. And so the very first fund was actually a solo GP fund that I raised on my own in 2017, and you can kind of see the progression of where we've gone. Steph and Mary joined during the second fund, actually quite close to each other in time, and so we were about halfway through the second fund when Steph and Mary joined. And then the three of us raised Fund Three and Fund Four together, and then we had Anna join 2 years ago. While we've been in the middle of Fund Four, and we are going to start investing out of our fifth fund early next year, which is exciting as well. So just to kind of give you a visual of like where we started as a firm and how we've grown over the last decade and the time it's taken to get there. And then we did want to quick talk about, we want to get into some of the questions that you guys sent us ahead of time. And so a lot of the rest of this, we'll talk about some of those questions and try to frame it around that. But we thought as like a framing, it would be really important just to understand like the business model and how venture capital actually works from like a money dynamics. Like where does the money flow? How does the money flow? Sometimes when we're talking to startups, we ask them that question, like how does the money flow? Where does it flow to? And so it's kind of cyclical. It should work out to be cyclical in the long run if you're doing well. And so we go out and we raise from limited partners, or LPs is what everybody calls them. And that's everything from high net worth individuals to institutions like endowments, corporations, nonprofit organizations, and that could be like school endowments, that could be a wide variety of things. It could be large corporations that we have as investors. And so the money comes from those types of pools of money, and they invested in us. We call that capital down over a certain number of years, and we invest that into startups. And then hopefully some of those startups exit and return capital back to us. And so, 10 years later, might have a large exit where a company that we invested in at $10 million valuations exits for $100 million or $1 billion. That money comes back into the fund. We return it to LPs because they're an investor. So hopefully we're trying to return multiples on their money over a 8 to 12 year time horizon. And then they invest in our next fund again, and it becomes a cyclical type thing. And we get paid in two different ways as funds and fund managers. And what's pretty industry standard across a lot of private equity is called the 220 model. So we take a 2% management fee on all of the funds that we have under management. So if we have a $40 million fund under management, that 2% fee annually is going to be $800,000. And that goes to cover salaries, travel, expenses, rent, all of those things. And then where we, really can try and make money is, especially as a micro fund, is on what's called a 20% carry. And that's the 20 of the 220 model. And so once we repay all of our invested capital, so once we give people back their $40 million, every dollar that we return on top of that gets split 80-20. 80% goes to the LPs, 20% goes to the firm. And it's a really long-term investment and a long-term hold. But you can see where if you have a really outsized performance in any one fund, you could really do quite well in the venture space from a carry perspective. Just a quick note of like I mentioned how that cyclical model where you go from LPs to venture funds to startups to venture fund back to LPs. So this is kind of how it looks like in deployment cycles. So you have your first fund, second fund, third fund, where you construct your portfolio, and that's first time investments. So we call it the portfolio construction period. We're going to make 25 investments out of each fund. We're going to do that over about 3.5 years. We actually have 6 years to invest, but those last 3 years, we're really just reinvesting into companies that already exist in our portfolio. So after that first 3 year period, that's when we launch our second fund, and we're rebuilding the new construction period of fund two. We're also reinvesting into fund one companies at the same time. And then you repeat. Most of our fund lives are about 10 years. But in reality, we expect most companies to exit in between 8 and 12 years. And so every time we start a new fund, all of us sign up for at minimum a 10-year commitment. So we're saying we're in it to win it. We're going to do this for 10 years. We're going to invest capital. We're going to manage the money. We're going to reinvest. We're going to work with those founders for a really long period of time. And you can kind of see how this stacks over time. And so as you get to later stage funds or more and more funds, you're really managing a lot of portfolio companies. At Bread and Butter, we've got 85 portfolio companies right now. We're reinvesting into companies that are in Fund 3, and we're still building our portfolio on Fund 4. And that's the real life example of Bread and Butter today. And the last piece on this, so what we're going to talk about is like I talked about returns and that cyclical nature. If we make 30 investments out of a fund, we expect half of them to go to zero, where we'll invest $15 million in 15 companies, and that'll all go to zero. We'll lose all that money. For about 35% of those companies, we expect to get our money back a 1x or a 2x return. And really, VC Power Law says that the majority of our returns are going to come from about 15% of the portfolio companies we invest in. So 10 to 15%. So in a portfolio of 30 companies, three of them are really going to have significant returns. And what we call those, we think of those as like fund returners. And so every time we invest in a new company, we ask ourselves the question, how does this $1 million investment return $40 million? How does it become a 40x for us? And if we don't see that path, we're not going to invest. And Mary's going to talk a little bit more about what venture backable means here in a second. But that's what we call the VC power law, is that we're not expecting small returns from all 40 of our investments. In fact, we're expecting to lose all of our money in half of them. And it's only going to be three that really return any real meaningful capital. And it's going to take at least 10 years for that to happen because it's a real long-term investment.
Thanks, Brett. So shifting gears to talk about the thesis and how, as a firm, how do we build our investment thesis? So an investment thesis is essentially what's your theory of the case, right? What gives you conviction and what's going to give you that path to those returns that Brett just spoke of. And so I think about, well, venture capital is such a business of optimism, meaning you're investing in the future and what could be and thinking huge big picture vision. It's a business of discernment too, where at Bread and Butter, we're seeing 2,500 deals a year, top of funnel. We're making anywhere between 6 to 10 new investments per year. So really that funnel starts to narrow pretty quickly. So we get very specialized in thinking through our thesis. So from a thesis perspective, you think about, okay, what stage are you underwriting? So at Bread and Butter, we've chosen seed stage as our entry point, which for us means company is live product and market, at least early version, typically generating, early modest revenue. Let's call it about 250K or so annually at the time of investment. And we're thinking about utilization, engagement data, what makes this sticky? Why are customers going to love it? So that's our, the stage perspective. Sector, we're going to get into in just a second, but are you a generalist fund, meaning you invest in everything possible? What we've seen in the current market in venture, especially over the last 6 years, is a lot of specialization where you're really differentiated because you get very, very good, deep expertise in one or two or three core things. So sector is the next important thing. And we'll dive right into that in the next slide. So as we think about our thesis at Bread and Butter, I talked about seed stage, right? Which means we're writing on average up to $1 million first check. So we're going in early in that early stage company. We're trying to own roughly 10%. So if you think about putting in $1 million at 10% ownership, that's roughly a $10 million post-money valuation. And we have flexibility within that, but roughly think of that. Geographically, what's your thesis? Ours is really a focus on the US. And we're leveraging our Minnesota backyard where we're particularly strong in big enterprises in the three verticals that you see here. So from a sector perspective, Bread and Butter has chosen to double down on these big three, and we'll talk through them in just a minute. But think about if you were building your own firm from scratch, these are the identifying factors of what gives you an unfair advantage, what gives you the right to invest and win in these categories. And this is how we've thought about it across Bread and Butter. And so diving in next slide into our actual sectors, we have three big sectors. And we talk about, we're based in Minnesota. We're investing in what we call the Minnesota home field advantage. So as I alluded to, Minnesota is home to the highest concentration of Fortune 500 companies per capita in the United States, particularly strong in a few big areas. So one is healthcare, right? There are more than 1,000 healthcare companies headquartered in Minnesota. You think about Medtronic is here, Mayo Clinic is here, Boston Scientific has a huge presence here, a lot of payers and health systems. So our North Star in healthcare is we want to invest in technology that democratizes access to quality care for all. That's intentionally super, super broad. You see some of the specific areas that we're proactively hunting for solutions in. And to give you an example, right, it's equally important to find what you're not going to do. So we're not doing FDA regulated medical devices and pharmaceuticals, but rather underwriting software and tech-enabled care. And so here's an example of a company we invested in our third funds. We've been investors for uh, 5 years now in a company called Delphina that's really building this um, AI-powered algorithm for maternal fetal monitoring to be able to predict complications in pregnancy and then come up with a comprehensive care plan to help ultimately save, better health outcomes for mom, baby, and whole family. So we've been with them since their pre-revenue, very early days. Excited to say they've scaled nationally, raised a large Series A round a couple of years ago, and just really continue to grow. So it's an example of what's a company that we get really excited in a category that is so large and impactful like women's health.
Then the next sector is food, and from a high level, what we think about in food, I like to call it full stack food. So it's everything from on-farm supply chain, manufacturing, logistics to future food retail, and anything that affects that. If General Mills, McDonald's, U.S. Foods, Ecolab, Target would be a purchaser of your software or your product, then we consider that food tech. And similar to what Mary was saying, sometimes it's great to say what we don't invest in. And in the food space, what we don't invest in, we don't invest in any CPG companies, and we also don't invest in any ag inputs. And to make it real for you, there's a company called Hungry in our portfolio out of our first fund. That's one of the largest companies in our entire fund families. And what they're doing is they're using software systems to connect really high-end, great restaurants with corporations that want a wow experience when they're bringing catering in. We've been with them since very, very early on, their first institutional round of capital, and now they've gone on to raise, beyond Series C and are in multiple states, and really well positioned to what we hope to be one of those fund returners I talked about earlier on. And then our last sector is enterprise. And so, some people are talking about like vertical AI and things like that. But what we really focus on are a couple of four key areas: supply chain, future of work, future of manufacturing, and future of commerce are kind of the core areas that we think about in the enterprise space. And that's, again, it ties to what Mary said from a thesis perspective is what do we have access to here in Minnesota? And Minnesota has the highest concentration of Fortune 500s in the United States. And we have a formal partnership with all of them. And so we wanted to work that in, and we feel like we are uniquely positioned to make investment decisions in these spaces as well from a thesis perspective. And again, just to make it real for you, there's a company called Knit, which is a company that we met when the founder had just dropped out of university, actually, to chase his dream. So he dropped out of University of Virginia to run this company, and we were immediately impressed by him. And Anish is just a wonderful CEO, and they've grown tremendously over the last 6, 7 years that we've known them. I mean, what they do is they're really rethinking the way corporations collect consumer insights. And so consumer insights space has been dominated by a couple of players over the years, and it's really antiquated. And so they came in and wanted to rethink how to do it. And these guys are off to the races so far.
So we're going to talk a little bit about now shifting gears, venture capital. When is it the right path for a company? And we like to say when you're starting a business, starting a company, there are so many ways to capitalize a business, and venture capital is one extremely specific type of capitalization. So really, it's not often that it's the right path, frankly, is my point of view. But when is it the right path? So if you're building a company that is on a fast growth trajectory, and think again about the fund life timeline that Brett laid out earlier, that 10-year fund life, the day you take venture capital investment, you kind of start the clock on that, right? Which is that I am building a company that is intended to have exponential growth. Often we look at, 3x or more year over year growth in terms of the pace of a growth of a venture-backed business. And then I am going to grow that, scale that quickly, and then have an outcome, a venture exit within a 10-year time frame roughly. And a venture exit, there's two paths. One is through M&A, right, being acquired by a larger player in the space. And the second is by going public through an IPO. And those are the two outcomes that we look for in venture. And so thinking about that, if you are starting a business that you want to pass on and be generational company that I would give to my kids and my grandkids, VC is not the right path for you, right? If you're building a business that's not capital efficient, or sorry, intensive, meaning it doesn't require a large amount of capital. Let's say it's a services company where I'm providing direct services to clients. Maybe I could just bootstrap that and build revenue and grow through that organically, in that case, I would own 100% of my company and not give up equity to venture investors, right? And there's no pressure there where the clock starts. So I like to say it's the right path if you're on that growth trajectory, if you're building a business that requires capital to scale, and if you have goals and expectations aligned with a large venture scale, right? The 25, 40x return within that 10-year time frame. And if so, this can be a fantastic option.
And we want to take a second to just kind of walk you all through what the early stage venture capital landscape looks like today, because it is constantly changing and constantly evolving. I am going to remind everybody that's on, if you have any questions, please feel free to put them in the chat. We're going to get to the Q&A section quickly or here in the really near future. So don't be shy with questions. So right now, as we sit in 2026, the venture capital world is very, very different than it was just 5 years ago in 2021. Um, and what we have today is it's like a barbell effect in the venture capital world. And so you have these mega multi-billion dollar funds that have gotten really, really large over the last the smaller, what I'll call micro funds that are sub $100 million funds. And and it's really become like a true barbell where you have, as we sit today, a lot fewer number of deals done than we had in 2021. But you'll actually see the median valuation of deals being about the same in 2021 as they are in 2026. And so what's causing that is you have these mega funds that when you're managing billions and billions of dollars, you can't write a $2 million check or a $3 million check. It's just really hard to deploy that much capital with really small checks. And so you have to write 30, 40, 50, $100 million first checks into companies. And what that does is if you're writing a $100 million check, you can't write a $100 million check into a company at a $50 million valuation or 100 million or even a $200 million valuation. And so you're writing really, really large checks into companies with bloated valuations that are not yet burned. And what they're doing is they're investing in companies that have real high potential, specifically in the AI space uh, at really high valuations that haven't been proven yet. And then you have those micro funds, the smaller ones that are doing smaller deals at much lower valuations than what you saw in 2021, because that area is a lot less competitive today than it was 5 years ago. Just to give you an idea, in 2021, there was about 2,500 micro funds that existed and were actively investing in the United States. And today, there's about 1,200. So that number of funds that exist that are actively deploying capital to startups has been cut in half from a small perspective. Now, if you look at the total dollar amount's about the same amount today as it was in 2021, the amount of capital that's available to be deployed. But so much of that is in those big giant funds that are writing far fewer checks, but at just extreme valuations. And so it's a really interesting market, and it's unique, certainly unique to my entire career in entrepreneurship, the last 25 years that I've been building companies or investing. It is a truly unique environment today that I have never seen before or never experienced, where you have kind of that dichotomy and that barbell effect in venture. One of the things it means for people that are interested in getting into this space is because there are a fewer number of funds out there, it will be a bit more competitive to get into a smaller team. On the flip side, those large giant funds, are actively hiring and are actively bringing people on board. And so, but it's a different dynamic as far as where you want to go and what kind of fund you want to work for. Also, all of those 1,200 funds that shut down, those people are looking to stay in venture and looking to see what their opportunities are outside of what they were doing prior to.
Which is a perfect segue into the next section. Oh, that's coming up soon on careers and venture.
And real quick on just like one last thing on venture and venture mechanics and models is like some questions we got around how do you know if you're doing well as a venture fund? Well, there's a couple of different things that we track and metrics that we track. There's something called MOIC, which is multiple on invested capital. There's TVPI, which is total value versus paid in capital. And so all of these metrics, those types of metrics, there's ROI, which is return on investment, obviously. Those metrics are saying how much is your portfolio worth today relative to how much, basically how much capital you've invested. And so those are indicators that are commonly tracked across the industry. And when we're getting judged by our investors, that's one of the things that they look at. Unfortunately, those tend to be those can be very misleading indicators because they're lagging, they're based on unreasonable valuations, they go up and down wildly. The only real accurate thing that you can really point to is DPI, which is distributions. Like how much cash have you returned to your investors? And so that's a real lagging indicator. Like how much cash have we given back? As I said earlier, it takes 10 years for most of these companies to exit. And so if it takes 10 years, then how do we know if we're doing well? One of the things that, our team at Bread and Butter loves doing is tracking the underlying assets within our portfolio. And the assets are just the startups. And so what are their KPIs? How are they doing? What's their revenue growth look like? How many of them are still alive? Just survival rate. When you know that a lot of your startups are going to go, like every company that's still alive has a chance because I can tell you as a founder, like it's an absolute roller coaster. Every big company thinks they're going to die 4 times throughout their journey. And so if they're still alive and still actively building, they got a chance at building something special. So survival rate, revenue growth rates, those are some of the things that can be good leading indicators of whether you're on a successful track. And then we also do measure, happiness of our portfolio companies. Like, do the companies like working with us? Are they referring people to us? Are we active in our community? That's important to us as well. And so there's a lot of other ways you can have an impact as a fund that are measurements of success. But at the end of the day, what we will be judged on by our investors is how much cash do we give back to them. It just takes a long time to get there where we can point to it and say, look, we're really good because here's all the cash we gave you back. And so there's some other stuff that we do think about along the way.
So I'm going to shift gears a bit and talk about career pathways. And we have a lot of questions in the registration about these, what are ways to get into venture capital? And I would say to a T, and anyone you talk with in venture, there's no one linear path, right? It's often a windy and unique journey. But we have a few archetypes of our friends and of our team that we wanted to kind of just walk through and a few pieces of advice for you if you're interested in that. So there have been a few different, well-worn paths into venture capital. One is the path that Brett took, right? Which is the entrepreneur path. If you go build a company, you've gone through that journey, whether you were venture-backed or bootstrapped, tremendous amount of lessons learned on that side of the table. And you see a lot of people pivot from, successful founder journey and then on the other side of allocator. So that's one that we see a lot. The other is more a path like mine, which I would call an operator path. When I was at Google, I was my specific muscle that I've built that I like to bring to support companies is around business development, go to market, that operating support of those years in the middle that I was helping do that at Google. And I was early at Google. I was roughly employee 2000. We scaled up to over 100,000 people before I left. I think being a part of that growth journey from the operating side lends itself well to you have a skill set that you're then going to be able to help roll up your sleeves on after you deploy capital into a company. So that's another path. And the other historically was more the traditional finance path, especially at these larger firms where they have, more of a career ladder, a traditional ladder. If I'm going to become, be an analyst for a couple years, be an associate for a few years, maybe leave to go to business school, come back as a vice president on a path potentially to get promoted to partner. And that's still the case for large firms where there are multiple levels of role, if you will. And so you see that as well. I think the biggest piece of advice that we would share, one is there is no one size fits all. And today's era of the pace of evolution of AI and tech in general is so rapid that things are shifting. So I would say absolutely some pieces of advice. If you're interested in entrepreneurship in venture, getting experience through the startup lens in any role is extremely valuable. Having sat on the other side of the table is extremely valuable. The second thing I can say is, try to build a superpower. What's your moat? What's your differentiator? No matter what role you're interested in at a firm, what is the perspective that you are going to bring? And I can share humbly, even though coming out from all those years at Google and going into VC, I made a lateral move from an operator role into an investment partner role at Revolution, the firm I went to there. But the difference between that and being an actual fund manager, where you have responsibility for A to Z, I really think that this time of in my career was the perfect inflection point. I don't think I could have done it, frankly, before then, because all the things that you need to successfully be a fund manager, one is the ability to raise capital. Two is the ability to source excellent deal flow and have a broad network where that's coming in, or you can go proactively hunt. And the third is having a broad network to be able to support companies meaningfully after you invest. And so it's a long game, and there's so many exciting ways to enter, but just share kind of a personal perspective there. And then lastly, it's just say yes, right? Show up. These days we get so many inbound from really brilliant and wonderful students, and the most thoughtful ones are the curated ones where it's like, hey, I took time, or AI helped me research you, your firm, your thesis. I noticed you have a pattern of investing in companies of XYZ. Have you seen this other company? And here's my analysis on it versus a, hi, I'm interested in VC. Could I grab 30 minutes with you? So thinking about how you can show up and really go the extra mile. Steph, I know we're going to segue into platform. I wondered if it might be a good place for the question from the chat around uh, maybe in conjunction with platform, just how do you think about the different roles on a team?
Absolutely.
Mhm.
Absolutely. So I am a partner on the platform side. Platform is a really interesting word in VC, just since we're so tech adjacent. And it means something different. I get hit all the time with people trying to sell me security things for our platform. Platform means two things in VC. One, it can be used to describe almost everything at a firm that is not an investment role. It can also be used to describe specifically portfolio support. So you kind of want to watch and see, like, they mean both. I'm on the board of an organization called VC Platform, which is kind of a global community of people on platform, and we've got people in data, events, marketing, all sorts of different areas. The smaller the firm and the fewer people you have on the team, the more you're going to not see as differentiated of a position if between like platform ops, BD roles. The larger a fund is, the more you're going to see these amazing opportunities to come in and really focus on one specific thing. It might be events, it might be marketing, it might be BD specifically at these larger firms. And the key skills, just to answer, I think Anwisha, that's your name. Hopefully I got it right. To answer some of those questions about like key skills as people think about getting into this platform ops world. Experience at startups is always great, but I think more of it is to Mary's point about having a superpower in one area can be super helpful. And so whether that's you're extremely organized, you're amazing at events, but you're going to do a full platform role, something like that can be super helpful. We're seeing more and more data and technical positions at VCs, so that's also another opportunity. The other thing is curiosity, like wanting to kind of do anything, raise your hand for anything at a firm can be a really great opportunity and a really great way to get in the door on the platform side. We're going to show, if you go to our next slide, we're going to show a couple resources about that. And so I just want to highlight one on here since we're going immediately from platform, then I'll highlight the rest. So You Want to Work in Platform is an amazing newsletter that comes out, I think, twice a week. It's got jobs across the platform spectrum in all the different areas that I talked about. It also has internships. It also has all sorts of things. So that's one to definitely look at. We're going to send all these resources out to you after with links, but some resources if you want to dive into things like thesis, if you want to dive into things like structure, all these sorts of things. Check out our Medium page. You can book office hours with any of us at breadandbutterventures.com/community. There's a great YouTube channel called Brett's Brain where Brett shares tons of little videos that talk specifically about different elements of both VC and startup world. So everything from what's the difference between a convertible note and a safe, to how do you express your go-to-market strategy. Venture Deals, if you haven't read it, it's just a classic, great book that really gets into some of the nitty-gritty of how venture works. We recommend it to basically everybody. A few podcasts here that are great that you can listen to, both stories from VCs and startup founders to learn more about this area. Get into the community. Find your community, whether it's a focus for, stage of life, gender, whatever it is. Find your community and start meeting other people. To Mary's earlier point, when you're getting into VC, having that network and be able to tell that story of that network is huge. And then just to keeping up with what's going on in VC, Term Sheet, which is Fortune's publication, is a great one. Axios Pro Rata sends a newsletter almost every day with new deals. And then I know we've got folks from all over the world here. Figure out what's going on in your local startup ecosystem and dive into those local publications so you can keep up to date with events, with big happenings, all of that sort of stuff. And with that, we're going to switch. Brett, you want to take the presentation down? There we go. All right. Let's dive into some questions. We've got a whole bunch of them here on the side.
If you want to ask something live too, feel free to
Yeah.
raise your hand, and we can call on you if you want to raise your hand and ask something live.
I'm going to ask kind of combine a couple of these to stay on the employee side of like, what do you look for from an analyst role? Is it scouting? Is it experience? All of that sort of stuff. Are micro funds actually hiring analysts? And do they really not come from finance?
So I think it is not to say that they don't come from finance. It's just more that at a larger firm, you have more people, right? And more levels and more volume in terms of that. Often at a small and a micro fund, really the limitation there is the budget, right? With a small team, and Brett talked through the business model of the management fee. You really have more of a bootstrapped lean team, if you will. And so I think as funds grow and we stack those funds on top of each other, right, then you start thinking about broadening. But typically it's if it's a lean team, a lot of team members are wearing multiple hats at all times. So absolutely, the business is finance. So having strong fundamental knowledge is hugely important too. I think that's a baseline. And then thinking about what are some of those other areas of expertise and superpowers that you can build on top of those skills to help you with scouting, right? Or help you with an industry expertise or AI fluency, for example. So absolutely, you can target funds of all sizes, but often the micro funds just have fewer roles.
Well, I mean, one thing, we're not at most early stage funds like seed and earlier, even Series A, you're not really running like DCFs and a lot of the stuff that you get taught at like an MBA program or a finance undergrad. We're not doing those types of things. And so, we are thinking about business model. We're thinking about like, how do they make money? We certainly help when we look at financials at a board level, but we're not running and building like any type of crazy financial models when we look at a startup at Bread and Butter. And we actually outsource and we work with a partner that helps manage our financials and does financial preparation for us, which is true for most micro funds as well. So we actually work with what's called a fund management company, and there's a lot of those out there. And so, sure, we do work on our own financial stuff ourselves internally as well. But I think sometimes people think like venture, you're running these big models. Like when you get to later stage private equity, they do that. At earlier stages, we're kind of like, how good are these founders? And can have a big exit. So
The team and the dream. I think that dovetails nicely into Ben's question about B&B invest in seed rounds, but curious to share a way to value pre-revenue or early revenue. Just thinking about valuations in general, it's a great question. Anything in that early stage, which we would go all the way up through Series A, really, right? That early stage zone, there is less business diligence and there's less traction, revenue, progress to show. So when you're raising capital, certainly at pre-seed, seed, and even into Series A, often the valuation is just a function of dilution, right? It's what percentage of the company are you giving up in that round? Are you selling those shares to investors? And the general rule of thumb, kind of straight up the middle, is you can expect as a founder to be giving up anywhere between 20 to 30%, 25%, let's call it straight up the middle of dilution in a round. So if we have a pre-revenue company or an early revenue company that's raising 2 million, right? 25% dilution would put that at an $8 million valuation. So that's kind of a general baseline. There are factors that could move that in either direction. In one direction of I might have to give up more than 25%. So I raised 2 million at a $7 million valuation. Let's say if it's a super competitive market, if we call future financing risk, meaning it's very hard to raise additional capital in that vertical, that could push your valuation down. Factors that would push your valuation up might be, hey, we've got a dream team of founders who are second time, third time founders. They've worked together before, they had a big exit before. Maybe you can go out and raise two at 12 million post money, right? So there's factors there, but thinking about valuation as a function of dilution at the early stages is how we think about that.
Right, we've got a question about if a founder is unable to properly meet the expectations and demands of the business when it scales into a different stage, what are the different ways B&B would deal with that and approach the founder?
Yeah. So, I mean, I've we've had companies where the CEO does, step aside or leaves at different stages of the company. I mean, the reality is that the person that goes from 0 to 1, um, isn't always the right person to take a company from 10 to 100 million in revenue. And it's actually a very different job. Like the kind of that zero, we think that what we ask is like, can this founder get us to Series B, which is about $10 million in recurring revenue right now in the current market. You have to get your company about 10 million in recurring revenue to be able to raise a Series B, broadly speaking. And it's really hard to replace a CEO founder before that. It's really hard for them to step aside before that, because the company's just not, it's hard to attract a really good replacement CEO or replacement person to come in and run a company that is still that early. The really good people want to have companies that are like well established, well financed, all that stuff. And so we always like, can this founder get us to Series B metrics? And then after that, to be honest, like it's actually been pretty easy for us most of the time. I know like most of the stories are written about like, the combative ones where somebody gets fired and they don't like each other anymore. The reality is it's actually not like that. That's what you read about because those are the interesting stories. Most of the time, people are pretty self-aware, and oftentimes the original founder um, doesn't like being the CEO of a 10 or 20 or a $50 million company with 500 employees because they're no longer like executing. They're now managing, all they're doing is managing their investors. They're hiring people and they're just not in the business as much. And so they tend to not actually like running those companies. So some of those people don't like those companies running that type of company as much as building the early stage. And so it's actually usually relatively easy conversations, but we do have like, all of us on our team are really careful to be like really honest and transparent with all the founders that we work with from day one. We try to build like high levels of trust as we're supporting them throughout their journeys. And so if we see something, we can say something. So we can say like, hey, you know, do you still like this job? Do you still feel like you're the right person to be leading this company? And so you kind of have a conversation, and that's how it starts. If you're going to start thinking about transition, and it can be really long, grueling. It's a really long, grueling journey as well. It's not an easy thing to do to be a startup founder. It takes a lot out of you, and so you ask those types of questions like that. So that's kind of how we think about it. And at the end of the day, once you do get to a later stage company, you've raised a lot of capital, like the board can fire the CEO if they feel the need to fire them.
Mary, do you want to share a little bit about how we work with portfolio companies after we invest and kind of our expectations there?
Sure. So two-way street, right? In that we're each vetting each other, founders vetting investors vetting founders, because it really is a 10-year journey if things go well. And so it's really important to have that alignment. I want to answer this with two answers. One is just from an expectations and communications perspective. We set a pretty structured, streamlined process. So whomever is the lead partner on the deal does a monthly one-on-one with the CEO just to check in. We have a working Google Doc that we track things in between, but we're also very available asynchronously. So WhatsApp voice notes, text, you name it. We can troubleshoot things quickly, but we require every company that we invest in to send a monthly written investor update, hopefully to all their investors, but certainly to us, that tracks the same KPIs or key performance indicators month over month so that there's total transparency. We want to know, the good, the bad, the challenging, so that we're in lockstep together. So that's from a transparency, communication, expectations perspective. Separately, we think about, and this is really the area that Steph leads and has built out for us, right? Is how do we support them at scale? What are the majors and minors, if you will, of where we're really going to roll up the sleeves and have expertise? And the minors, anything you need help with, ask us. We'll try our best. But the majors for us are three things. One is fundraising support. So how do you help them raise the capital for future rounds? We have 600 firms in our co-investment network that we've built relationships with. So when you're ready for Series A, Series B, we want to help you run the tightest, most efficient process possible with the right materials, with the right introduction. Second is PR and marketing. So especially at the early stage, you're resource constrained. It's super expensive. We're fortunate that Steph, among her many talents, also is a journalist by background, and so it helps create the scaffolding and actually help execute on a lot of this early visibility, brand marketing, PR work. And the third, the big lever of the business is money, right? So how do you help make customer intros, biz dev intros to drive commercial progress and revenue growth? So those are the three areas I'd say. But when you come to bread and butter, one of the biggest questions we ask ourselves in our investment decision process is bread and butter uniquely equipped to help this company? And if the answer is no, we will say no, because if it's just capital, you can get capital from a lot of places.
Awesome, thanks. I see somebody on an iPhone has a question.
Yo, Mickey Tolsner with Graded Shoes Company in Minneapolis. We're a 7-person company. We've been making a lot of traction. We have we believe a very solid idea. We have StockX reaching out to us, but we are having trouble getting a meeting from anybody. And I would just ask if you have any advice on that.
Yeah, I mean, how to get meetings with funds. Um, Step one is put together. We have all of our portfolio companies put together like a target list of 100 plus funds that they've done research on. So go through, do research, and it's not pulled down like a list from there's a bunch of like public lists out there that you can just pull down in spaces and sources. And make sure you're appropriate for like their thesis, like what Mary walked through. So stage, geography, and what types of companies that they invest in. So make sure that you're, and then I tell people to tier them into 3 tiers: tier 1, tier 2, tier 3. Tier 1 is like your dream investors. Tier 2 is like people that fit stage, thesis, geo, all those things. Stage 3 is like the more generalist ones that's tougher to tell if they're a good fit. And for your tier 1s, like you're going to do everything you can to network to them. So you're going to have 4 meetings to get a warm introduction to them. And so like the short answer is there's no easy way. It takes a lot of work and a lot of networking, a lot of conversations and a lot of coffees. And it's like, meeting somebody that knows somebody that knows somebody that knows somebody to get to them. That tier 3, it's going to be more cold outreach, and you're going to hope that somebody sees it and is willing to respond to cold outreach. But it also goes back to like just like getting a job in venture, and that Mary talked about earlier, which is like you got to show up. So where are these people congregating? So go to every startup event in the community. Go to every single meetup in the community. You go to like when I first was an entrepreneur, I first moved here. I literally went to everything because I didn't know a single person. I didn't have any network. And I went to every single startup event in Minnesota that I could find. And then like once I was a little bit more established, like 2 years in, and some people knew me, and they'd be like, "Hey, will you come to talk to my high school class of 5 kids that are thinking about being entrepreneurs?" I'd say, "Yes, I'll be there. When is it?" So I said yes to everything. And a couple of decades later, like you have a pretty broad network, and but it takes time. And so like do your research, know where to spend your time, and then it's a networking game, and it's networking to get to those people. Another little trick is like if you see companies that are similar to yours that have raised capital, reach out to founders and ask them for warm intros, because founders tend to be a bit more open to like cold outreach from other founders. So
The other thing I would say, I would invite, and for everybody too, you're welcome. If you want to talk specifically about to brainstorm your specific case, feel free to grab office hours with us on our website, 20-minute virtual session with any of the partners here. But I think the other question is if you have market pull from a StockX, I don't know the exact nature of your business, but is there a market, are they a strategic investor potentially? Is there a commercial deal that funds you so you don't need to raise venture? If you have that kind of market validator from industry leaders, that's another question is that the right next step for the business? So yeah, but would welcome you to do an office hours with us if you'd like to dive in.
And William, I see you've got a question about how to kind of go from being somebody who actually does something with the relationships that they have versus someone that just kind of keeps them warm. From my perspective, and that's a lot of my job, right, is managing relationships. A few things. One, really be honest with yourself about the status of those relationships. Are those, you met at a party once and have seen maybe once in 6 years, or is this somebody that you've actually had like a sit down conversation with And if you haven't, do that. Try and get some time with them, try and get to know them as a person. The number one way to me that you provide value or that you get things out of your network is to provide value back to them. And I think I've had people send deals and things like that. Make sure it's something that is unique and differentiated to you that shows off a little bit of like, is it your access to things? Like if you're using this as a path into VC, is it your access to deals? Is it your network within other VCs that you can offer to make an intro? Is it specifically BD that you can make introductions to? Provide value back to someone so that when there's a point that you actually need to make those relationships count, you're in a position that you can make an ask.
I think that I was thinking back through all the people that I've worked with at my startups and or at the fund too that are college kids or people that have recently graduated university. And I think the ones that have like stuck and actually gotten real opportunities are the ones that say yes. So they make it known like, hey, if you ever need anything from me, let me know. Right. I'm happy to do it. And then we're like, oh, hey, we're hosting an event. Do you want to help check people into the door? You want to volunteer, so you're not going to get paid, and help check people in the door. And they say yes. And so they're just always around. They're always saying yes to things and showing a willingness to kind of do anything. And those are the people that have like I've seen really succeed and move quickly. Like not just succeed, but like get opportunities the fastest, or the ones that say yes to things that might seem like menial to get started. But that's a commonality.
I'm going to combine a couple questions from a few people about kind of that entry point into startup world of like either if you're high school, if you're college, if you're MBA, like what should people be thinking about? Do they need an MBA to get into VC? Should they take the startup path? Is there a different path that you can take? And I'll let you guys go.
I think from an entry point in school, get involved, right? And to Brett's point earlier, and if it doesn't exist yet, build it. There's such a cool, I was invited recently to speak to a group of high school students in the Twin Cities Metro that were hosting an investment conference for high school students. And they have a club and they formed it and they just planned it. And that's so cool. If that doesn't exist at your school and you're interested in it, could you be the one to lead it? At the University of Minnesota, Atlan Ventures, right, the student-run venture capital firm that has raised external capital and is deploying from LPs and is deploying like a traditional venture firm. Like, could you build that at your school? So these days, I think it's less about back when I was in school, these theoretical clubs around it, and now just actually doing it and experimenting and actually building it, which is super, super cool. Were you asking the question about the MBA question?
Yeah, I do you
Yeah,
think
I
you
mean,
need an MBA?
I think there's differing views on this, right? And which is again, no one linear path. And our team of three partners, Steph and Brett have MBAs. I do not, nor do I have a degree in tech, and I worked at Google for 15 years. So it's I think you can go really either way. I think what's important about those opportunities is to learn and to build a strong network of people from those schools, whether you're at a startup, whether you're at a company, or whether you're at an MBA program. You can build that everywhere. But I don't know if you guys have views. I think either way, right? And a mentor of mine, an early mentor actually, who built Google Ventures, had been a big champion of mine, had been pushing me to go into the investment side for some time when I was at Google. And I had the same question of like, should I leave and go get an MBA? And at the time, his advice was, you are very gifted at people and relationships and biz dev, and you can learn the math. Like you're a smart person, you can learn math. It is true. You definitely have to learn math, the math of venture for sure. And so I'm not at all suggesting don't go get an MBA, but I would say from personal experience, that is not by any means the only path.
I do think like one quick add. I think that there's a very limited number of jobs in venture, and it is a hard job to get. I think that a really great way to potentially get there eventually, if you don't get a venture right away, is to join a startup or start your own company. And so like that is a really common path into venture is to go work for a high growth startup, venture-backed startup, or start your own thing. And those two paths there's more of those. And so there's more opportunity. And you tend to get a lot more responsibility early on at an early stage startup than you do at like going to a big corporation. And so I think that's a great way to like dip your toe in the water and really get a feel for what it's like. And you can get noticed and move into venture that way.
The only thing I would add is if you're at school, you don't just have like you don't just have to look at the financial clubs as an option.
Yeah.
Do all sorts of clubs and activities. I would say one of the biggest things for me, um, for undergrad is, yeah, my degree is great, but I ran the big concert series at school. And so had all this hands-on production event type experience. That for me was extremely helpful in terms of my role in VC.
Yeah, and for like my MBA, I have an MBA. On it, like my MBA didn't teach me any like hard things that like finance or stuff that I couldn't have figured out that I needed for VC. So I totally don't think a MBA is required or necessary. But I mean, it's a great way to like build a strong network though, and so it can help you build universities. Whether both undergrad and grad schools are great ways to build really strong networks, but also like learning how to learn and learning how to influence. And so doing things like what Steph just said, or, the school I went to was like a case study school. And so like your whole education was influencing people. Like which is a really strong skill. So it's less about like the things you learn and it's more of like the life skills that you learn through them, that can be helpful.
All right, on that note, we've got 2 minutes left. What is one thing that each of you would do if you were in school right now to set you on the path to VC? Like
Start,
one next step.
start a company.
Mary?
I think it depends on which stage of school. I would say make the ask, right? Look at the people around you. Ask for a coffee chat. Ask for 30 minutes. The answer is going to be no a lot of the time. Don't get intimidated by that. Just keep going. Learn and expose and start building your network now.
Awesome. Well, we will gather all of the resources that we mentioned with links and more information and send them out. And as a reminder, you can book time with any of us on breadandbutterventures.com/community. Yeah, anything else?
Yeah, we're so happy that you tuned in. Thank you so much for the time. It's an exciting time to be in venture and we're here to be a resource. So thank you all and best of luck to everybody.
Good luck all.
Thanks, everybody.
Benjamin, you got your hand up. I'll stay on for a second and answer your question.
Yeah, I do have a question actually. So I'm actually a student in Singapore. So I just got started into the venture capital landscape. So I come from a startup background. So I worked for an early stage startup and I used to work for a early stage accelerator VC firm
Mhm.
as well. Did.
Yep.
So right now I just joined on board Level Up Venture as a venture scout with the team
Great.
as well. So I just thinking about asking in terms of how to, because I don't have the experience in terms of like identifying high potential startups to invest in because we are agnostic firm. So I just want
Sure.
to ask advice on how to identify startups to actually potential invest
I think
our
I saw
funds in.
and I saw your question in the chat also. I mean, the things that we care about are like
Yes, right.
team, product market traction, right? And it's like about
Okay.
that ratio. So team is by far the most important thing. But like if you're thinking of
Okay.
like sending deals to like random firms, I would say like do make sure you understand their thesis really, really well. So like
Okay.
and send stuff that's really, really specific to them that fits like stage, geography,
Okay.
that thesis stuff that Mary talked through. Like make sure if you
Understand.
send a deal that is like a really tight fit in with the thesis of that fund, and that's
Okay.
what'll stand out. And then don't be discouraged if you're like, nope, not interested. Because like, just to give you an idea, like as a firm, we probably look at like 2,500-ish deals at the top level.
Right.
I probably meet with 300-400 startups a year, and I'll lead 4 deals a year. And so we see a lot of deals that we pass on and don't think about. And so and we are geo focused on US markets. And so like, and so making sure again, it just comes back to like the understand the thesis of the firm that you're sending deals to, and then send them things that are very, very specific to that thesis. And that's the best way to stand out.
Because I'm thinking about using the experience as a venture scout and slowly getting um into like really big VC firms as an analyst role and slowly work my way up to become partner. So I just thinking of like, is venture scout a good way to continue working and break into an analyst role while taking a finance degree as well.
It could be. There's a lot of different paths though.
Okay, okay. Understood. Thank you. Oh, you do have LinkedIn? Maybe I can connect with you or something.
Sure. Yeah, I'm there. I get a lot of, yeah. I don't promise I'll say I tend not to use it go there very frequently. So just as a heads up, I think I've got like several thousand requests that I haven't responded to, so I apologize.
It's all right. Thank you so much for your advice, Brad. Appreciate
Yeah,
it.
yeah. Jack, you've been on. Feel like you got a question.
No, I was just listening to him, trying to get as much information as possible. So thank you for your time. I appreciate
Yeah.
it.
Where are you based, Jack?
I am in Lakeville. I'm going to University of Tennessee, and I'm gonna be doing mechanical engineering there with an entrepreneurship minor. I'm trying to go the startup route, and I'm just trying to learn about venture capital and investments into that. So
It's cool. Like I said, like my last thought, like honestly, like if I didn't start my first company until right after I finished university undergrad. And I mean, there's not a better time than while you're in school, especially like back, I'm old, so like way back then they didn't have entrepreneurship. There was no entrepreneurship degree. There was no entrepreneurship classes. There was none of that. Um, and now there's so much support for founders at universities in the US. And I mean, if I could go back and start a company, that's what I would do. I would spend like, I would do my coursework too, but I would be like, all my excess time would be starting companies, like trying to find one. So that's what I would do if I was
yeah,
you.
especially with all the AI stuff, it's just moving so fast. So
Yeah,
thank you.
it's really cool. All right. Thanks, y'all. Oh, sounds like I'll stand for one more. Sure, run it. What's up? Only if you come off, yeah, you got to come off, yeah, there you go.
Hi, thank you for your time and for your explanation. It was really good. I just wanted to ask one thing. So normally how the VCs work or how they invest in these sectors, they have their favorite sectors to invest in. So right now, how if we want to enter into the VC world, how we find which sector will grow and we should focus on it, something like that, or
Figure it out. Like what are you interested in? What have you do? Where do you have in expertise? Like where do you have a unique competitive advantage? Like what excites you? There's no right answer to your question. It's just like what excites you? What would get you excited about? What would you want to do? Why are you uniquely positioned to do the thing well? And so that's what the question you have to answer. I can't give you an answer. It's like figure out what you're passionate about.
because there's the consumer investments are interesting and the space sector is growing. So
Cool.
a
So
lot
then
different.
then focus on that, man. Like then go do that and get some experience there. Then go do that.
And
All right,
how
I
do
gotta
you,
jump. I have to jump too. I have to run to my next meeting, but it's good meeting everybody. I appreciate you
sorry,
all jumping on.